Hey everybody! Alright, I'm going to do a quarterly review here with the S&P 500 C Fund for those of you guys who are TSP and don't really know what I meant by that. As you know, TSP, the C Fund follows the S&P 500. It's the easiest index for me to keep good data on and keep track of what to expect from it, what it is going on with it, and with earnings. Because if we know what's going on with earnings, we know what to also expect from the price. All right. So I want to talk about a number of things that are, some of the end of the quarter numbers that might interest you. All right. So just if you're interested in seeing what's really going on with the index and what maybe to expect over the coming quarters, keep watching. All right. All right, we're going to start with this slide here. It's should be fairly recognizable for a lot of you here. So as of the end of the quarter, the total market cap for the index is at 58 trillion, almost a little bit below 59 trillion dollars. That's with adding up the market caps with all 500 companies together. And total trailing 12-month earnings, based on my number, it's 37.76. All right, so and in next 12 months, basically the same company's earnings a year out from now. Basically, it's the trailing 12 is what's already been reported, and next 12 months is what that trailing 12 months is expected to become a year from now. It's 42.93. Actually, I forgot to make some little changes there, but don't mind the 1371 part. The 12.02% part is the part that matters. That's what I expect S&P 500 earnings to grow by over the coming year. It's still a good healthy amount. That's better than the long-term average. So that's the reason why I recommend you stay mostly in stocks. And if you follow Deb, she's going to be staying 100% in stocks as well. I'm 100% in stocks myself, but I do tend to swing trade. So for most of you guys who are going to be watching this, I do recommend you just follow Deb's advice. Or if you're a little bit more wanting to be conservative, work your way down to here where it says where this beer data is. It says 90% stocks, 10% bonds. That's what I would recommend. Every week I do review and update that information. I do also post that in a separate post, and also have all this information available in the main announcement post in the Facebook group. So do watch that post regularly. That will, if you watch that post regularly and know what you're looking at there, there'll be a number of questions that it can answer without you having to ask. All right, so please watch that. All right, current value right now with trailing, basically with adjustments made that I have for certain like constituent changes and stuff like that. It is at 43.25. Future value basically is what I expect the current value to be a year from now. It's at 48.45. So I do expect it to go up another 500 points over the next year. And as long as the growth trajectory, the earnings trajectory stays positive over the, let's say a year from now, it's still projecting north. Then expect the S&P 500's value to also be north of that 48.45 number. Based on the current 12% growth rate, I'm currently projecting the index will be up about 5105, or right around the 5100 level a year from now. All right, swing out targets and swing in targets. Those for those of you guys who are in the Swing Traders group on Facebook. Right now, the trading range is 44.25 to 45.85 normal. It is down lower though. It actually ended the quarter just above 4,300, and you'll see that a little bit later here. But 44.25 to 45.85 is actually what I think is the reasonable trading range for it right in the short term. Okay, also I talked about the beer ratio, which is bond equity earnings ratio. That's 90% stocks, 10% bonds. And like I say, if this number here comes down to a lower number, and or the 10-year Treasury note yield goes up to a higher number than what it already is at, which we'll talk about in another slide here, you will see this gradually shift more toward bonds. Yeah, it's right. It's maybe at 90% now, but next month it could be down to 85% or even 80% or whatever. Just depends on what the earning. We do have a new month of a new slew of earnings data coming in later in October. So as a lot of those companies start to report updated earnings, the 4 month out, the 4 quarter out data starts coming in closer and getting replaced with or the four. Getting new data coming in for the 4 quarter out period. All right, so trailing price to earnings ratio for the index that I have calculated is 26.94. That is up. That is pretty high, but it's pretty common to see this in bull market conditions, I think. And also the forward PE ratio, it's 23.69. So it is still projecting upward. Um, with bond yields as low as they are, I think that these PEs being elevated is kind of justified, to be honest with you. So I'm not really concerned about these at the moment. When bond yields start getting up higher, above 3-4%, whatever, then might start justifying a little bit lower PE ratios than what we're seeing here. But for the moment, bonds are not very high at all. And again, we'll talk about the bond yields on another slide later on here. All right, this next slide it shows what we've done over the last 5 quarters. And this 1 quarter ago part basically is what just happened. Those are strong earnings, 11.18 basically for the quarter alone. The cumulative amount for the 4 quarters is at 43.25, as I mentioned in the other slide. That is up from 38.05 last quarter. And I do expect it to go up to 45.55 next quarter, by the end of the next quarter, I mean. And up to 47.30 2 quarters from now, 48.15 3 quarters out, and 48.45 4 quarters out. And as you do see, just on a quarter-by-quarter basis, the strongest growth is right here in this next upcoming quarter, and it is tapering off. So do expect that the price growth is going to slow down as well. I don't think it should necessarily be negative, but I do expect that it will slow down some. And yeah, I think we do have some transitive issues there with the earnings, with mainly with inflation and supply chain problems. But I don't think that it's going to be a long-lived issue. I don't really, at the moment, expect that we'll see any kind of earnings recession either. But that could happen. I could be wrong though. Well, we'll find out as the next quarter progresses. All right, on a 12-month basis, yeah, we're still right here at over 13 and 2/3%. And it will again taper off as the year progresses. Okay, for those of you guys who invest outside of TSP, I have this information available, especially for those of you guys who have IRA accounts or who have regular stock market, as we call it, taxable brokerage accounts, TBAs. You'll see TBAs mentioned a lot in the Facebook groups, and a lot of people always end up asking, what's a TBA? Well, that's what it is. It's a regular stock trading account, like Ameritrade, E-Trade, Robinhood, those kind of accounts, all right? But this tells you what each sector is expecting for earnings performance over the next year. And generally speaking, wherever the strongest growth is where you should expect the strongest price growth also. Now, this isn't necessarily going to be ideal for everybody's stock investing strategy, especially if you're a dividend investor. You're going to be more interested in what kind of dividend yields they are, and you're going to be looking at different data points than what you're looking at here. To an extent, these can actually help you with dividends, because if you're already in dividend-paying stocks that are in good sectors here, and the earnings growth is expected to come, then there's a better chance that your dividends are also going to get increased as well. So that's something else. But as far as buying into dividend-paying stocks, a lot of times investors, what they do is like to wait, look for opportunities when the price drops down to where they can sneak in some extra percent yield out of their dividends when they do buy in. All right, but anyway, as you see here, energy sector is still expecting the strongest growth at over 265%. But it does seem to have a higher PE ratio than all the other sectors. So might want to keep that in mind. We'll keep an eye on it, but um, based only on the earnings alone, I would expect that that the energy sector stocks should perform better than other sectors. Other strong sectors you see here by rank would be industrials, consumer discretionary, materials, and information technology. And in consumer staples, those are your, I'd like to normally see, I think consumer staples a little bit lower than that, but it's not a real big problem. Utilities and, well, particularly utilities is what we want to watch for. We want to really like to see it down at the very bottom. It's toward the bottom, but it's not all the way down. And financials, I'd really also like to see up a little higher than it really is. But um, doesn't mean that we're in bad shape economically. But bank stocks, maybe not going to be looking so great right now. As you see, they're projecting down, or financial sectors, not just banks, but also insurance companies and stuff, projecting downward at 4%. So there is going to be a little bit of an earnings recession for utilities and financials. I can't really say that for real estate because I have a hard time with their data because they report their earnings by funds from operations. And with ever since Ameritrade got taken over by Schwab, the data that which is where I get my information from, they tend to translate it over to uh, non-GAAP earnings, so I can actually have it in the same uh, format as everybody else, because that's the only sector that reports their earnings in that format. So they're a lot more difficult to work with now, so they're extremely unreliable as far as that's concerned. I recommend you talk to Scotty Cox. He's a long time member of our group. He's been around since I think within about the first year of the group's existence, and he knows a lot about the real estate sector. So if you ever want to learn more about that sector, I would say he's one of your go-to guys on that. All right, now looking at all the quarters since I started keeping these records, which was in the second half of 2015. All right, so this the very bottom here is the quarter that just ended. Had 504 companies, 504 stocks. I mean, out of the 505. There's really 500 companies, but 5 of those companies have 2 share classes, and all of those. Now each of their share classes gets counted in my data here. Main takeaways from this is that at 86% earnings performance over basically the same quarter over the same quarter last year, basically third quarter of 2020 versus third quarter of 2021 is what I'm comparing right there. 443 of the companies reported positive earnings performance. Only 3 of them were neutral and 58 were negative. That means 87.9% of them were reporting positive earnings performance. If you look at all my records here, there's not one single quarter since I've been keeping these records that we've seen a number that high. We almost got up there in fourth quarter of 2018, but so this tells you just how insanely strong this quarter that we just finished was. All right, moving on to bond market data now. This is, I know, always a lot of gibberish for you guys here. It looks like Greek, but I want to really look for trends, and I can kind of explain a little bit here. Short-term yields, the 1 and 2 month yields, tend to bet on what the Fed funds rate's going to be on the next Fed meeting, FOMC meeting. At 0.07% or 7 basis points, as we would put it, they're not making a really strong bet on the Fed to increase their interest rate to 0.25% next on their next meeting, but it is elevated from what it was before. As you see here in August, it was down at 3 and 4 basis points, so it's up a little bit more, but still a long way off from the 25 basis points I would expect it to be hitting when they're betting on the Fed to announce a rate hike. So as you see, though, when as more FOMC meetings come, as we get closer to the time where they're going to increase the rate, you're going to probably see the bond market, the short-term yields here, jump to right into that 25 range or so if they think that the Fed's going to increase it by 0.25%. Or it could even go up to 50 basis points if they think they're going to do a 0.5% rate hike. Long-term yields, the ones in the blue-gray color here are the ones that affect the G Fund's performance. G Fund is based on all outstanding Treasury notes that have at least 4 years remaining to maturity. So any of these that can potentially be at least 4 years long, 4 years remaining, are the ones that are in the blue-gray. That's why I have them that color. As you see here, the growth rate's not very good right now. Generally speaking, when the rates are stable, I expect it to be somewhere in the ballpark of where the 10-year yield is at, which is only about 1.5%. Another way you can find out how the G Fund's yield rate is, approximate growth rate is to do a simulated TSP loan request. You don't have to actually do the request. Just go through the motions like you're going to request to do a TSP loan. And when it gives you the information on what the interest rate is that you have to pay yourself back at, that is the approximate rate that G Fund is growing at. All right, 30-year note, it did climb back up above 2%, as did the 20-year note. I don't have the information in here on this slide, but when I did look at this before I took this screenshot, I did take a look when the last time was the 30-year yield was up above 3%. Because when the long-term yields get up higher, that's when we expect the growth rate on stocks to be a little slower also. It don't mean that it's going to be negative, but expect as bond yields go up higher, they become more attractive investments. And stocks also tend to not perform quite as well. Yeah, they're still going to grow a lot of times, but just not quite as strongly. So you'll see that gradual shift from with my beer ratio thing that I was talking about earlier. They're still down really low right now, so I don't think you should be concerned about what's going on with the bond market or stocks at the moment. But keep your eye on the main announcement posts in the Facebook groups, and when you do see those shift more toward bonds, and if you're concerned about having too much money in stocks, just watch that stock bond ratio recommendation in the main announcement post of either group, and just follow that. And and the diversified distribution suggestion I have in that same post will keep you in that same neighborhood as well. All right, I also have a comparison of the bond yields here with I'm looking for inversions when these numbers turn negative. And 2-year versus 10-year is the most commonly looked at one. It's actually going the other way, though. The gap between the 10-year and the 2-year is actually getting larger and more in favor of the 10-year note. As the bull market tends to get older and closer to a possible recession and bear market, we're more apt to see an inversion here where they actually turn negative, and that's where we're trying to keep an eye on. It's going the opposite direction, though, so that's a good sign. I don't think you need to be very at all concerned about this. All right, this is a monthly look at what the 10-year Treasury note yield has done since looks like right around the beginning of 2017, perhaps. It's generally been down, as you see here. It bottomed out in earlier months of 2020. kind of inching its way back up now, but it's kind of trending down over the last few months. And look at the bond yield curve here. This is another one that I use to kind of illustrate how looking for inversions or what a healthy economy looks like when it's a nice step ladder look like that going straight up. That's a really nice healthy looking economy. There's a slight inversion here within the short term yields. I don't really know what's going on with that. I'm not a bond market expert. I know a fair amount about the bonds, but I'm not an expert in this area, so I don't know what would drive that or what uh, little clues that might give us with that going on. But I do know that long-term yields, up higher like this, are good because what happens is banks tend to borrow money at the short end to help fund money for basically the money they need to lend out to other borrowers like you and me for home loans or for business loans on the long end. So it's basically a form of leveraging. And when it's too expensive for them to borrow money on the short end to fund these longer term loans, the supply of money coming back into them at higher interest rates, it becomes less cost effective, and they're less likely to issue out loans to people with more questionable credit history or whatever. It has to be cost effective for them, and right now this is telling us it is extremely cost effective for banks to lend out money. All right, looking at the TSP share prices here over the last month and a half or so. Mainly the right side stuff is, I know this is a lot of noise here. This is just day-to-day information here, these first four columns. Next four are for the month. iFund did have a nice little run there in early to, looks like mid-September. Even getting into the later part of the month, it was the strongest performer out of the stock funds. So I can see why some of you guys might have an interest in iFund lately, but looking at the year performance, it still looks like it's all C fund. I don't know. I'm not personally interested in iFund, but there is information in here that kind of gives hints that maybe it is worthwhile to have something in there, or make some plays on that perhaps. If those of you guys who want to actually make moves on that. I personally plan to stick with my own strategy, though, which does not really involve iFund unless I know iFund's going to be a longer-term strong performer. All right, looking at the price versus earnings performance over the last, over so many quarters here. We just finished at 4307.54 on the index price at the end of September. And as I mentioned, the 12-month earnings are at 43.25. This is actually below the earnings level, so it's actually projecting, it's pricing in a very small drop in earnings right now, as far as what this is telling me. I don't think that should really be the case, but I'm not surprised either, because like I said, the 4 quarters out data, it does kind of project a slowing effect. It's just a matter of, is it going to plateau and then go back up, or is it going to plateau and go down a little bit or something? But I expect that it'll probably plateau briefly and then continue upward. But again, I'm not an analyst, but I can tell you what the earnings data is saying, and we are in an earlier part of a bull market, in my opinion, and I don't think that we're close enough to the end of the cycle where I would expect a legit recession to come up. All right, and this is the same data that is projected onto a line chart. Just to give you an idea, we ideally want to see the blue line above the orange line. When the blue line drops below the orange line, that means the market is pricing in drops in earnings. And as you see here, there have been a couple of times where they priced in drops, but didn't really have the drop there in the earnings itself. It had maybe a slight drop here. We can look over here. Very small drop right here from 30.38 to 30.15 back in 2019. Third and fourth quarter of that. But then it's been trending upward. Well, there was another drop right there, but Not very long. Yeah, it didn't last long at all, and you see, it didn't take too long for the market to price to shoot prices back up. So that's another reason why you say don't move to G fund to flee from falling prices. You go to a G fund because bonds become a better investment opportunity than stocks. That's not because you're fleeing from stock funds. This is what the problem is that a lot of people have, and they make a lot of incredibly bad moves, panic selling because they see a leak and don't realize that it's just a short-term thing. The market's very emotional and short-sighted when earnings tell another story. And if you follow the earnings, you're going to be more likely to make better decisions long-term, all right? So watch the earnings, please. All right, we had 5 constituent changes in the index this quarter. These are the ones that happened. Moderna, they replaced Alexion because they were acquired by AstraZeneca. They were the first one this quarter to be replaced. I honestly don't know why Moderna was added to the index. They did have the right market cap to fit in there, but they didn't qualify on earnings, in my opinion. So I don't really understand why they were added. I kind of think it was just a COVID thing or whatever. Um, I'm not really sure. It kind of seemed like a little bit of politics or something going on there. But whatever the case, they are in the index now. The next one that came was in August 30th. It was Biotech Corporation. It's a pharmaceutical company, actually life science tools and services. It replaced Maxim Integrated Products, which was acquired by a fellow S&P 500 constituent, Analog Devices Incorporated. And in just a week and a half ago, I had 3 more that got replaced. Match Group, it's the same Match you're thinking of, that online dating site company. And also Ceridian HCM Holding Incorporated. It's a company I'm not really familiar with, but they are an application software company. And you got Brown & Brown Incorporated, which is an insurance broker. All 3 of those were introduced to the index from the S&P 400. While the other 3 there you see, Perigro, I forget what UNM was, and Novad, or I can't remember what that one was also. Those were all market cap changes. So basically, the 3 that you saw leave the index there, these 3 got removed from the index because the market cap got too small for large cap S&P 500 standards, and the other 3 got added because they were large enough to fit in there or to belong in there. So, generally, we tend to see about 2 dozen or so constituent changes per year. This particular year has actually been a bit slow, though. I will have more information on that at the end of the year when I do my end of year data. But it's been a little bit on the slow side with constituent changes this year in general. But I'll cover that more in detail at the end of the year. For those of you guys who follow me and my strategy, I need to move this red line up, relocate it up because it doesn't move on its own. Basically, this line here where the 0.00% is at is where when I did my last IFT to 100% S fund, and I reset basically where C and S are at relative to each other. The blue line would be what S fund has done relative to C fund. The red line should be right here where this hash mark is. And I just forgot to move it, so it's actually even more below the red line than what it looks like. It did get pretty bad there, but again, it just takes patience. I'd like to be able to make more moves, but I can be as patient as I need to be. I'll stay 100% S fund until I see it climb above that red line, and then only after I see it cross the red line and maybe get a couple of percentage points above it is when I expect that I will likely swing trade again. Okay, well that sums up all the information I have here. Again, the reason I post all this is because stock prices tend to follow earnings. And if we pay attention to what's going on with the earnings, you'll have a better idea what to expect from the prices as well. If we start seeing the earnings dropping, then we have a more valid reason to expect the stock prices to drop as well. We're not seeing that right now. We do, like I mentioned, I do see a plateau possibly coming short term, or it might flatten out, but I don't really expect that it's going to be much of a drop, if at all. Yeah, again, it could be like a 2014, 2015 when we had an energy sector recession where most everything was flat and or slightly positive, but then the energy sector single-handedly was holding down the entire index and making the whole entire index's performance just flat, and up to maybe a 1% negative. It was hovering right around flat low, within 1% in either direction for a couple of quarters before it resumed its upward trend. That's what I think is more apt to happen right now. We have supply chain issues, and transportation issues going on right now, but I do think that that'll work itself out over time, and once those do get resolved, the supply chain will be able to catch back up to some of the demand and get us moving back in the right direction again. So, all right, that's all I have on this one. I don't want to make this too excessively long. I still have a weekly thing I want to cover as well, which I probably won't work on tonight, but I will. I'll have to work on that as well. So, you guys watch out for that one. I do tend to talk about what the top 100 S&P 500 stocks, which ones are reporting, which ones did report, and then of course across the broader index. Who's expected to report? How much am I expecting my current value of the index to change by over the coming weeks, and a little stuff like that. All right. So that's all I have, and appreciate you guys taking the time to watch. I'll see you guys on the next one. Thanks.